This is the current federal tax developments for the week of June the 1st, 2026. Current federal tax developments are brought to you by your state society of CPAs. And again, Ed Zollars here coming to you from Phoenix, Arizona, where we're going to discuss what happened this week in taxes. Basically, for this week, we're going to start by analyzing procedural timeliness and automatic extensions through the CARP decision. We're also going to look at a private letter ruling detailing how to salvage a spousal IRA rollover when trusts and estates complicate the beneficiary chain and you inherit something you realize is a problem. We'll also cover two tax court cases involving fraud, one examining collateral estoppel for an innocent spouse filing jointly, and another dealing with improper corporate deductions. And finally, going to wrap up with updates on the rollout of the new Trump account that was announced late last week, and also review the 2027 inflation adjustments for health savings accounts and related plans, including the new DPCSA, new acronym. We'll have fun with that. So let's go into our first topic now. This is a U.S. Court of Claim opinion filed on May the 21st, 2026. This is the CARP case, and essentially, this ruling is crucial for us as practitioners because it explores what happens when a taxpayer makes a technical error in estimating their liability on an extension request for an income tax return. And specifically, the court looks at whether such an error can invalidate a refund claim when the government already has adequate funds from the taxpayer's prior overpayments. And again, the case here is CARP versus United States, case number 1:23CV00926-MRS. I love those Court of Federal Claims cases. And this one was filed on May the 21st, 2026. The core of this dispute centered around the CARP's 2016 federal income tax return. Now, the CARPs had this history of overpaying their taxes, specifically in 2014, 2015, and 2016. Because they assumed these overpayments would cover their upcoming bill, they filed their Form 4868 extension with a $0 estimated tax liability. Now, the government fought back, arguing the $0 estimate failed to account for all their income sources, which voided that extension entirely. Interestingly, you might want to share this detail with clients who get frustrated by IRS inconsistencies. While the case was pending, the IRS actually acted as if the extension was valid. They agreed the return was filed by the October 2020 deadline, mailed the CARPs the $154,720 refund set check, giving credit a portion of the overpayment to the couple's 2022 taxes, before ultimately deciding to challenge the claim's timeliness. So we were kind of deep in all of this as it moved forward. Now, to understand how the judge arrived at her decision, we need to review the legal framework. First, under IRC Section 7422A, taxpayers cannot sue for a refund until a claim is duly filed. Automatic extensions are governed by Regulation 1.6081-4, and the IRS explicitly warns that an unreasonable estimate on line 4 of the 4868 renders the extension null and void. However, the court emphasized the precedent set in the case of Crocker versus Commissioner. The Crocker standard dictates when the estimate does not have to be perfect, right? Very simply. It simply must be a bona fide and reasonable estimate based on the information the taxpayer had at the time the request was made. And this distinction between a perfect estimate and a reasonable estimate is going to be the deciding factor in this case. Now, the government's main argument was that a zero estimate was materially wrong because the CARP's actual gross tax liability was $131,201, right? They just said, oh, we're going to have no tax. Well, yeah. They were going to have $131,201. They were, however, likely to be overpaid. Keep that in mind. And Judge Silfen noted that while the taxpayers made a technical error by estimating their net liability instead of their gross liability, this error was not unreasonable enough to void the extension. The deciding factor was the mechanics of the carryover payments. Once the CARPs filed the 2015 return, that overpayment was deemed paid on April 15, 2017. Now, there was some mix-up here, and it took a while for the IRS to finally get that transferred over. But eventually, the IRS agreed that they were overpaid and agreed that that applied to the next year. Therefore, the ultimate estimate they would owe $0 out of pocket for 2016 was factually correct and was reasonable based on their expectation. The court specifically distinguished this from cases like Fleet Boston Financial Corp., and the CARPs weren't trying to offset a deficiency in a completely different year. They were simply accounting for their own carryover payments. They believed once the dust settled, there'd be zero tax due on this return. Now, of course, the IRS is looking at it a little differently here. And we have the issue here because we're, kind of looking at whether an extension was filed, looking at, the issue of when did the CARPs go to court in time? Now, in the next move that's really relevant, the judge dismantled the IRS's argument that a Form 4868 estimate is strictly necessary. And this is where what the IRS has done in recent years comes back to haunt them. The court pointed out the IRS website offers 3 ways to request a 6-month extension, 2 of which are electronic. More importantly, if a taxpayer uses the online payment method and their liability is covered by payments and credits, no estimate of tax liability is required at all by the IRS on that site. The judge firmly stated that penalizing the CARP simply for using the older paper-based method constitutes a trap for the unwary taxpayer. The court noted that what this really seems to indicate is our main concern is there a chance there's a huge amount of tax outstanding that's owed and, the taxpayers are covering that up. Not really what was happening here. So because of this, the court granted the CARPs cross motion for summary judgment, holding the extension was valid and their refund claim, therefore, was timely and payable. That's part of their deal. Now, what does this mean for us in our day-to-day practices? First, due diligence on extension methods is critical. If you have a client whose tax liability is already fully covered by prior payments and credits, using the online payment method, theoretically, it would appear to the IRS, hate to say in this case, but the way it works, would appear to be a safer route since it completely eliminates the explicit requirement to estimate the tax. Now, again, the judge says that's ridiculous. And, the IRS shouldn't be able to penalize you for filing on paper because had you just gone online and done essentially the online payment method and said my payment's 0 for this extension, they'd accepted it. That's basically what it is. But it is technically true that per the instructions and per the reg, that method is the safer method today, weirdly. Secondly, the case solidifies the deemed payment principle as a powerful defense. Successfully carrying forward substantial prior payments is strong estimate that the client's 0 estimate is reasonable, right? And finally, remember this reasonableness standard from Crocker versus Commissioner is contextual. Courts are increasingly hesitant to let the IRS use old procedural forms as a weapon when the agency's own modern electronic alternatives bypass those requirements entirely. The IRS leaves off this issue from the online payment way of getting an extension because, frankly, they don't need it. They don't care, right? That's what they're communicating. Now, if the IRS believes that's an important issue, then there really should be a requirement on that line, on that screen, to put a number in for how much you think your gross tax is. But that's not what it requires. So we have, again, like I say, as always, we have our infographics that are stuck into the slides. If you go to the website, currentfederaltaxdevelopments.com, on the weekly updates for audio or video, and download them, or if you're watching the video, you can see it on the screen now. This is a summary of the dispute with CARP. The CARP's net estimate of $0 and the court's redetermination of $131,001 gross liability, which ultimately still resulted in a valid extension because, again, the court thought evidence seems clear. The IRS is concerned with how much net you owe them, not really so concerned of how we get there, except on the old paper form 4868. That would be it. The court then ruling came down and went to the fact it was a technical error, but it was still a reasonable estimate. They validated the deemed payment and it said, look, they're deemed paid at that date. They owed you nothing because the IRS tried to argue that, well, because the IRS hadn't yet applied it at that point, technically there wasn't an overpayment. But the court was kind of, come on. Be real about this. That's largely due to problems in your own system as to why it hadn't been applied yet. You eventually agreed to apply it, and you agree now that it's applied. It's treated as if it's paid in April of 2017, which would have been well before this extension was filed. So, IRS, what are you talking about here? And as noted, it does recognize, though, remember, the IRS did take this to court. The IRS did push this. A trap for the unwary of the paper 4868 or even the electronic 4868 that we file through our software, both ask for an estimate of total tax, then an amount paid, an amount net due, and then, how much you're paying. Now, we understand that now for years, basically we've been told you don't even have to pay it, right? You'll have failure to pay penalties, but you won't have to pay the balance due for an individual. But they're still asking for the other two items. Bottom line, I have to wonder if the IRS will ever finally, maybe Congress, and I guess Congress needs to allow this. We'll have to see. Whether we're not going to move to what some states have done, most notably California, that simply grants everybody the automatic extension, but says if you owe tax, here's a payment coupon, and if you don't send it on April 15th, we are going to charge you, penalties for that. So be aware of those backgrounds. So anyway, what we have today. Now we're going to move on to the next topic. This is estate and retirement planning. A recent private letter ruling issued on May 22nd, 2026, private letter ruling 2026-21003. This ruling tackles an all too common, yet not exactly great situation a client gets in. What happens when a decedent's IRA passes to a surviving spouse not through a clean, direct beneficiary designation, but rather by defaulting to an estate, pouring over into a trust, and then the spouse would get it. So, bottom line, this is the case of they failed to designate a beneficiary, let's say, so the estate is a default in the IRA document, which is where we're looking. Therefore, it goes into the estate. The estate leaves everything to a trust, and the trust leaves everything to the spouse. This is a very poorly executed estate plan. Unfortunately, we often see those. Like it or not, people don't like talking about dying. That's reality. We know they're going to, but they don't like talking about it. These things happen because they just go to the attorney. That was distasteful because I had to think about dying. And then as life continues to go on and keeps happening, they never talk to anybody again about this whole plan. And we end up with this situation. So if you're advising on these matters, we can understand how the IRS allowed a taxpayer to navigate these strict prohibitions in the Treasury regulations regarding defective beneficiary situations. But please note that it required a private letter ruling, and I'm pretty sure that's going to be required in most cases. We'll talk a little bit, but I don't think a lot of custodians are going to be comfortable at all with accepting an inherited IRA or a conversion of an IRA to the spouse's name if it's gone through the estate and then the estate goes to the trust and they just start eyes glaze over time. They may very well demand this protection, which does have some costs. But let's look at the facts of this situation per the letter ruling. So we got to look at this defective chain of events, right? During the decedent's life, the decedent executed a last will alongside a trust. The standard revocable living trust planning exercise, right? We have a revocable living trust. The trust is, all assets of the deceased or all assets of the taxpayer are transferred into the revocable living trust. And there's also a will because this covers a case that we know that there are some assets maybe we can't transfer to the RLT. And we also know that there are people will screw up. They'll refinance a home. The bank will have the home retitled in their personal name, and they'll never put it back in. And because of that, the person dies and the house is outside the trust. They open up a new brokerage account. The broker, doesn't, just puts it in their name because that's what they do. They don't remember they're supposed to title the name of a trust. So we have it, sitting out there by themselves, all kinds of reasons these assets end up outside the trust. And we also have the fact, which sometimes maybe, I think it's often explained by the attorney, but it's one of those things the client doesn't really get it and they're not going to ask a question. But there also are assets that are basically that have their own outside probate transfers in this case. And, we end up with that issue of, so things like retirement plans, they generally have a beneficiary designation. And you have to realize that that designation, normally we're going to discuss whether it should go to the trust or whether it should go to surviving spouse. And there's a lot of issues there as to which one it goes to. But normally the surviving spouse is much better if you want to stretch out the IRA as long as possible. The trust may be better if you're concerned about the surviving spouse just taking all the money, running and leaving your children from your first marriage with nothing. That's also one of those issues. So we get into that. But in any event, none of that appears to be covered in this eventually, right? Okay. What happened here was the IRA initially designated this, the person who died. The decedent had designated his mother as his IRA beneficiary. Now, we don't go back to, how that happened. It didn't designate spouse. My guess is he designated mom as beneficiary when he opened it when he was single and never got around to even thinking about he should change that designation. And even didn't get around to thinking about it after mom died. So now we have a dead beneficiary. Now, because of this, issue, right? Because mom had died, so she's gone. There was no secondary beneficiary. So by the terms of the IRA, the balance would go to the estate. A state court admitted the will to probate, appointed the surviving spouse the administrator, and issued an order directing the IRA assets be transferred to the trust. The surviving spouse was the sole trustee and beneficiary of this trust. So the problem is here, we have IRA went to the estate because mom died, right? Totally fouled up beneficiary designation, however you look at that. Estate, therefore, provides that all assets go into the, any assets that go to the estate, everything's left to the trust. So now the IRA first goes to the estate, then goes to the trust. And now the balance of the IRA is supposed to go to the sole beneficiary of the trust, who, by the way, is the surviving spouse. So it's a long and winding road, to quote Paul McCartney. But, it's like, but we eventually get to IRA goes to surviving spouse. Ultimately, whenever all the dust settles. But the problem is it didn't go that way, and it went through a lot of processes that are going to suggest that we have some real problems in the designated beneficiary rules and the rules involved with sending an IRA, a spouse being able to treat an IRA that the spouse inherits directly as their own, which is what they want to do in this case. So where we're at. General rule under Section 408 D1 of the Code is that any amount distributed from an IRA is included in gross income. While IRC Section 408 D3 Cap A provides an exception for 60-day rollovers, inherited accounts generally cannot be rolled over tax-free. The technical hurdle is found in Treasury Regulation 1.4088C1, which provides a mechanism for a surviving spouse to treat an IRA as, in this case, her own. This regulation explicitly states that if an estate or trust is named as a beneficiary, the requirement is not satisfied, even if the surviving spouse is the sole beneficiary of that trust. Because the estate was the legal beneficiary, the IRS formally acknowledged that the taxpayer could not make a direct spousal election. Right? We've got all these things in the way, and those things cause us a big problem. So facing immediate taxable event upon distributing the IRA assets, the taxpayer's authorized representative stepped in to request a private letter ruling. They sought 4 specific rulings. First, that the spouse should be treated as a distributee under Section 408. Second, that the account would not be treated as an inherited IRA. Third, that she was eligible for the 60-day rollover exception. And fourth, that this process would not trigger gross income exclusion. The goal was to give a clear legal pathway to move the funds from the trust, basically from the estate to the trust to a personal IRA. Right? It's going to go straight in and it's going to be in her name, which is going to give us the longest, basically the longest time period for her to be paid out in virtually all cases. Right? And this would allow it. And our real problem is here, we need to move it from the trust to her. And we don't want to do that by taking a huge instantaneous tax hit. That's the real issue we're looking at here. The IRS analysis gives us an administrative workaround the IRS approved of. Despite the strict regulatory language prohibiting estates and trusts from acting as conduits for a spousal rollover, the IRS decided to look through the legal entities. They analyzed the chain of custody created by the state court order and focused on the surviving spouse's dominion and control. It is really important that she was the executor/person representative and she was the trustee of the trust, right? She basically had full control all the way through. Because she was a sole trustee and had the absolute unfair authority to withdraw any trust assets at her sole discretion, the IRS deemed her effectively the individual for whose benefit the IRA had been maintained. This bypassed the roadblock. Now, like I say, it's not the roadblock's not there. It's that she had dominion and control from day one. Yeah, had to jump through a couple of hoops, right? We had to go through two different entities to get to her that shouldn't have been there, but we had to go through them. But the IRS said because she had full control of the whole process and she essentially, can direct the whole thing down the line, we're going to treat it as being being left directly to her. That's how we did this. Now, ultimately, the IRS granted all 4 of the requests. They allowed the tax-free rollover, provided it excluded any requirement of distributions, right? And for our practices, what this really does is reinforces that tax-deferred status can be salvaged even with imperfect beneficiary designations. But the facts have to align perfectly, and you almost always are going to need and want a private lead ruling to protect you. So this is probably not going to be worth doing if the IRA account is 10 grand. It's going to cost you more than the taxes involved for you to get the PLR approved with all the costs involved, the issues, unless somebody's admitting they totally fouled up professionally and is willing to pay for all of this, which also, frankly, they'd be better off just paying the tax, to be totally honest. At the end of the day, that's just what it is, right? So some key issues here. When this worked, remember the surviving spouse, sole fiduciary of the intermediate entities, both the estate and the trust, have unlimited discretionary power to distribute the assets to themselves. A final critical note eventually is the actual distribution of subsequent rollover must strictly happen within the 60-day window. Or, right, in that case, furthermore, if you encounter the scenario, you really should advise the client to seek their own PLR. If they just kind of go do it and get the check, suddenly they discover that, Chase or whoever, when they ask about this whole thing, because wait, you just got a check for this from the trust, and you're this person trying to put it in your own IRA. Yeah, they're likely to balk on that, right? They're likely to balk. You're going to need it for them too, because the custodian is likely to require it. And secondly, you want this covered. Because remember, your big risk is you had a fully taxable event. You failed to report a significant amount of income, right? Which means you're going to at least open up a 6-year statute in many cases, because you're going to have a substantial omission of gross income. And you're going to turn around and, basically overfund an IRA account, which will then have excise taxes due every year. And yeah, you don't want to get into that. So again, we've got our infographics. Hey, we do these all the time, right? This summarizes the complex path to resolution that they had to go through because of this. It is as shown there, a total mess and tangled mess of ways we've got to unwind this thing. The primary beneficiary's death created a tangled chain. It forced the IRA through the estate into the trust. Now, the IRS agreed to a look-through solution in this case, which relied heavily on the fact the spouse had total control, total dominion, total control over the trust assets from day one. She had total discretion to just move them straight to her, right? That's what essentially saved this. Had that trust not allowed her to move it directly to her, and it might not have allowed it because it was always assumed the IRA wouldn't go through there. And, you could end up with a problem there in terms of the trust wording. You could end up with a different trustee. You could end up with all kinds of issues that would be more complicated than this fact set. So it is a reminder that clients facing this sort of problem might be able to recover. We're talking about $1 million IRA. It's worth trying to recover. And yes, people with $1 million IRAs still make this sort of mistake, right? People don't like talking about their death. This is a when you die situation, and when you die is never an upbeat topic. Just hate to say that. So this at least, though, tells us how we can potentially handle this situation, a proposal to go get the PLR, and then with that in hand, be able to run through the custodians, give them the letter, show them that the IRS has blessed this. We're all good. Well, next topic shifts to the realm of tax fraud. We got a couple of tax fraud cases this year, and the civil examinations that follow criminal convictions. The tax court issued a memorandum decision in the Lee and Hugh versus Commissioner case, tax memorandum decision 2026-42, issued on May the 27th, 2026. This decision is an examination of collateral estoppel, the term, especially regarding the impact of the statute of limitations for joint filers. Collateral estoppel is basically, this has already been decided in a court of law, right? You've already basically pled this in a court of law under perjury, or you've basically, in this case, pled guilty in a court of law to what's essentially conduct that you're now trying to claim, well, no, I didn't really do that. It's like you can't relitigate that here. That's the idea of collateral estoppel. Right? And this is the impact on the statute of limitations for joint filers. And what's important here is to realize only one of the two spouses was convicted criminally of this issue. And so this deals especially with the impact on the unconvicted spouse, the one who has never made any position, never had to take a position, be found or pled guilty to be fraudulently filing a tax matter, right? Does that spouse have a chance to try to argue why, in this case, she was truly not fraudulent, even though her spouse on the joint return has now essentially been convicted of or pled guilty to tax fraud? That'll be the key issue. Okay, there are interesting facts in the case. Dr. Lee was a physician who ran effectively a pill mill, right? Unlawfully distributing controlled substances for cash. Right? The situation escalated in 2015 when the Drug Enforcement Administration raided his office and residences and seized over $1 million in cash. Yeah, we all just have $1 million in cash lying around, I'm sure. Yeah. To hide this illicit income, Dr. Lee maintained two sets of books, intentionally providing his tax preparer with a version that just happened to omit the illegal cash payments. That's kind of nice, right? We do it that way. In addition to not providing evidence that you got paid this money and then having to figure out what for, it also conveniently means you don't pay income taxes on it, right? Which makes it nice. He was ultimately convicted of 30 criminal counts. Now, 27 of them weren't criminal tax evasion, but 3 were, right? Yeah, when you sell controlled substances illegally, there are other laws besides tax laws you tend to get in trouble with. In this case. Now, following the exhaustion of his criminal appeals, the IRS pursued civil tax deficiencies against both Dr. Lee and his wife, Ms. Hugh, but correctly assessed civil fraud penalties under 6663 only against Dr. Lee, since Ms. Hugh was not a party to the criminal proceedings. So, on the penalty side, the penalties have only been assessed against him. In essence, they're not assessing them against her. But now the question becomes, what about the taxes that weren't paid on those funds, right? At the tax court, the taxpayers made a strategic decision. They conceded the existence of the underpayments entirely. Instead, they focused their defense on the statute of limitations, arguing that the IRS had failed to offer clear and convincing evidence of fraud, meaning the standard 3-year assessment period under 6501A should have already expired. Under the general rules, if the IRS is going to go for the unlimited statute, they have to offer clear and convincing evidence of fraud that fraud was committed. And they're saying here, well, the IRS didn't introduce that in this trial. Now, the IRS, relying on the exception in 65C1 for false fraudulent returns, countered that Dr. Lee's established fraud kept the period of limitations open indefinitely for both spouses. To support this argument, the government relied upon the general rule from a 1970 case, Bannerman versus Commissioner, which stated that proof of fraud against either spouse prevents the statute of limitations from running for both. Now, in this case, the tax court bifurcates their analysis, starting with Dr. Lee. The court reiterated Supreme Court standard then from Montana versus United States, knowing that once an issue is determined by a court of competent jurisdiction, it is conclusive in subsequent suits. Because the elements of criminal tax evasion and civil fraud are virtually identical in the words of the court, differing primarily in the larger quantum of proof required in the criminal proceeding. Right? You have to show a higher level, right? Proof beyond a reasonable doubt. Dr. Lee's 7201 conviction conclusively established civil tax fraud for those years for Dr. Lee. Sorry. Yeah, in essence, that has been proven you met the standard for this case because it was proven you met the standard for the same things provided for at a much higher level. The case was made. In other case, that court found you guilty of that. We're done. That's it. The statute is open forever for the underpayment of tax against you, Dr. Lee. Right? Since his appeals were exhausted, he tried to argue the appeals were still open, but the tax court pointed out, by the time you got here, the Supreme Court had turned down hearing your appeal. So even though your argument was they're still open, no, they're not. Right? The statute of limitation, therefore, was open under 6501C1, and the IRS motion for summary judgment against Dr. Lee was granted. Dr. Lee owes the tax and the fraud penalty. But what about his wife? Okay. Now, the court made a refinement to the general rule regarding joint filers. While the IRS pointed to older cases suggesting establishing fraud against one spouse keeps the statute open for both, kind of another little problem with signing a joint return, the court clarified that when the convicted spouse's fraud is established via collateral estoppel, rather than an evidentiary trial, the unconvicted spouse is not estopped. Rather, relying heavily on the Fourth Circuit's decision in Moore versus Commissioner, the court emphasized that applying collateral estoppel against an unconvicted wife based on her husband's criminal trial violates her rights. The famous line from Moore states, due process requires that she be accorded her day in court. She has not had one. He didn't go so well. She hasn't had one. The IRS tried to argue that Moore didn't apply because they're only trying to keep the statute of limitations open, not assess the 6663 civil fraud penalty against Ms. Yu. However, the court rejected this, citing Rodney versus Commissioner, which confirmed the IRS does not relieve its duty to prove fraud by clear and convincing evidence against any other person. Bottom line, we're there. Now, key thing to note here, this does not mean Ms. Yu is not liable. All it means is the IRS has to now go to court, actually go to court and try this matter. Do it, go forward. They would have to show that she truly, had committed fraud when filing that return. They can't just use, if all they got is he pled guilty and they have no other evidence against her, then yeah, she's not going to pay. They have to be able to carry their evidence against her. Because the IRS couldn't rely on his criminal record, the hurdle's just going to be way higher, right? Like I said, to prevail against her and keep the statute open for her has to establish by clear and convincing evidence that false or fraudulent returns were filed with the intent to evade tax for each of the specific years in issue. Now, we still have that crazy issue that's still bouncing around the courts, not totally decided, whether or not the fact that the return was fraudulent automatically means her statute's open. That is basically came back to life. Wasn't a Third Circuit decision we talked about earlier. Maybe it was late last year. That whole concept is playing around again. But that's not what the court's going for here, right? Okay. So because the facts underlying fraud are still in dispute regarding her assessment of the situation, the IRS denied the IRS motion for summary judgment against her, ensuring she has a right to litigate her liability at trial. Now, what this means is that the innocent spouse has innocent, quote unquote, right? Kind of quote innocent, not innocent legally in terms of, or I should say in terms of tax rule of that, but the spouse was not convicted, right? Has rights to defend their standard 3-year statute of limitation, even when their spouse is undeniably guilty of criminal tax evasion. Now, you're going to have a problem of convincing the court that you didn't know that it was a fraudulent return. Honey, what's this $1 million under the mattress? Don't worry about it. In essence, she's going to probably have to prove ignorance, of where that was and, didn't know about the $1 million that was stashed in the house and at the office, or didn't, care about that. And, didn't wonder why they were seen to be living beyond their supposed lifestyle, looking at the return. She has a bit that the IRS is going to go after, but she doesn't necessarily have the open statute. The IRS has not yet proved that. And again, we have our infographic. This is the two different rules. For Dr. Lee, he's convicted. We're done, right? The fraud statute is open in the civil case of the IRS, right? Now, for his spouse, his conviction does not mean the statute's open for her. Now, the IRS already conceded they weren't going to charge her the fraud penalty. Well, the court said, but that also applies to the open statute. She has her right to a day in court. Now, a right to her day in court does not mean that she's going to get out of this entirely. That's still to be decided should the IRS decide to pursue this case. They may very well decide that, they'll just go after him. Depends on relative assets, etc. But the IRS does have that option. And they have to prove fraud separately for her. Hey, it's a fraud week, right? This is another case dealing with fraud. This is the Shryrock versus Commissioner case, tax reform decision, 2026-44, issued on May the 28th. And this is a fraudulent failure to file, improper corporate deduction with a guy that you're just going to love, right? This decision serves as a stark reminder of severe consequences of failing to substantiate deductions and heavyweight badges of fraud can carry when established through deemed admissions. Okay. The petitioner in this case is Adam Shryrock, right? He operated a for-profit entity called Boobies Rock, I'm not kidding, right, Inc., which essentially engaged in nationwide fundraising events for breast cancer research. However, Shryrock utilized the business to collect donations that were subsequently deposited in the personal accounts he controlled, such an account named 7 Group LLC. The IRS determined that Shryrock received substantial unreported income from these diversions, including gross receipts from Square Inc. Yep, the people, of course, presumably the payment people, right? And constructive dividends for 2011, 2012, 2013 tax years. Complicating the matter for Shryrock, his history was characterized by a pattern of severe noncompliance. He had been enjoined in multiple states for deceptive trade practices and already pleaded guilty in federal court to one count of willfully failing to file his 2011 federal tax return. This guy is not going to make a good impression on the judge. Hopefully he realized that when he came in the courtroom. So let's see. Somebody who was stealing money from an entity, basically for fundraising events for research, and basically just instead of actually sending the donations on to the charities he was claiming to collect them for. He just took the money. I mean, yeah, you're not going to make a good impression on the judge starting with those facts. Let's just put it that way. When the case reached the tax court, the taxpayer made a critical procedural mistake. He chose not to contest the receipt of the unreported income or his failure to timely file his return. Right? Tax Court Rule 34B1G, if a petitioner fails to assign specific errors to the IRS's determination, those items are deemed conceded. So while he claimed to know the tax, he never told us why the IRS had arrived at the gross income number in error, or why they were in error about his failure to timely file his return. Didn't tell us what was the error in their finding. Wasn't told that. So by ignoring the IRS's bank deposit analysis and not challenging the nature of the receipts, he effectively removed the entire issue of his unreported income from the dispute, leaving him legally responsible for the underlying tax liability without a fight. Yeah, that's not a good move. Just going to say. Definitely not a good move. Instead of finding the income calculation, Shyrock's primary defense was that the IRS failed to allow substantial business deductions, including his cost of goods sold, labor, and over $150,000 in charitable contributions. However, the court said these expenses were clearly incurred by his corporation, the infamous Boobies Rock, Inc., not by him personally. Right? You cannot claim you are not. Remember, the corporation is a separate legal person and a separate taxpayer. You're not allowed to deduct expenses you paid, even if you paid them. You're not allowed to deduct expenses you paid for the corporation. They're the corporation's expenses. The corporation is supposed to claim on its return. Right? The tax court swiftly rejected his attempts to take any of these deductions, explicitly citing Aliotto versus Commissioner to remind the petitioner that a taxpayer cannot deduct business expenses of a wholly owned corporation under individual 1040. Even worse, the court noted that even if the expenses were somehow attributable to him personally, he committed the cardinal sin of failing to provide any records or receipts to substantiate the amount, which would have denied them separately. Yeah, this day's not going well in court for this guy. Just going to say, as it worked, right? Because the IRS asserted additions to tax for fraudulent failure to file under 6651F, the government bore the heavy burden of proving fraud by clear and convincing evidence. Without much of a fight from the petitioner, the court was able to look at the badges of fraud established entirely through his deemed admissions. IRS didn't need to prove the case, he did it. The court found several persuasive factors: severe understatement of income, inadequate records, engaging in illegal deceptive activity, and failure to make any estimated tax payments despite receiving substantial income. Unsurprisingly, the court noted his previous federal criminal conviction for willfully failing to file his 2011 return made determination of fraudulent intent relatively straightforward. In the end, there were no real issues of material fact remaining, so the court granted the IRS's motion for summary judgment, fully sustaining both deficiencies and the addition to tax. This case is an example of what not to do, right? In this case, it highlights the absolute necessity of ensuring our clients maintain strict entity separations. Corporate expenses go on corporate returns. Don't pay expenses out of the first checkbook you find. Clients sometimes do that. And when you decide to set up a separate entity, you now have the responsibility of keeping them separate. A, for taxes, clearly important. But B, talk to your attorney about what ignoring the corporation is going to do that supposedly liability protection you had by forming this corporation. But discover that whole liability installation will tend to fall apart if you are apparently totally ignoring the corporate form, which is what essentially you're kind of doing when you pay things out of the wrong thing, attempt to deduct them on the wrong return. That just makes it simpler. Talk to the attorney about this. They will probably be not very happy if you're doing this. Just say that. Right? Also, you are required to keep records. You need contemporaneous documentation, and you got to actively contest IRS calculations in tax court, or you're going to have deemed admissions And that can create a fraud determination without the IRS having to lift a finger, is what effectively happened here. Okay, back to our infographic. On the left side, the mistakes. Ignoring entities, mixing them, right? Taxpayer failed to report a lot of income. That's usually not a good move. And he had a long history of noncompliance. All of those got together to cause the problem. The court found that entity separation is absolute. You can't do that. Do not deduct corporate expenses on a 1040. Do not deduct 1040 expenses on a corporation. Right? Also, by the way, don't report income for a personal contract you have, to pay you personally, right? That where the contract's with you and not the corporation. Don't try to move that to the corporate return. We see that done all the time. And gang, it fails. It fails badly. Tax court cases on that have all gone against the taxpayer. When you form an entity, make sure you follow all the legal formalities. Any contracts for work should be with the entity, not with the person. And and all payments of expenses related to the work the business that entity is in need to be made by the entity, right? And it'd be really nice, preferably, to have, the entity be the party that contracts for all that work. That'd be really nice, too, in the end of the day, right? But as we said, in this case, they did their own proof for the badges of fraud, which is amazing. IRS really didn't need to do anything. And you've got to have something to substantiate your expenses. Yes, there is Cohen. You do not want to rely on Cohen. Those who don't know, it's a Second Circuit case involving George M. Cohen, the most cited case in the tax court. I never have totally verified that, but I would be shocked if there's a case that's cited more. There are a couple maybe that could be up there. They're just kind of throwaway sites we use. But Cohen is cited a lot, and Cohen doesn't normally work. Cohen says if you can establish that expenses were incurred and there's a reasonable basis to estimate them, then we can kind of overlook lack of records. But it's very kind of, and you still got to have some sort of record so we can estimate expenses, and that's usually a big problem. In this case, we're not even getting into Cohen. I mean, he never brought up the fact either, so that's a minor detail, but we're there. Okay, now on to a couple of final items here. Let's go ahead and transition over to some guidance that your clients have probably been waiting for. This is a rollout of the new Trump accounts, and we got some more detailed information about where we're going from here. On May 28th, the Treasury Department posted on their website a press release entitled Treasury Announces the Launch of the Trump Accounts app and Next Steps for Trump Accounts. This came out May the 28th, and it's going to discuss exactly what it says, right? So it's the launch, an app that you can use to access your Trump accounts, and the next steps for enrollment. So this allows us, it's a tax advantage investment, right, for young Americans. And we need to be able to guide our clients through this. And clients who did file the 4547 with their Forms 1040 already, they're going to start getting some contacts, and we need to be ready for questions about that. Okay. There we go. Now, going on with the launch here. Treasury Secretary Scott Bessent has emphasized that this initiative is designed to, quote, build long-term financial strength from day one for American households. That's a nice line politically. You do it, you sell the politics, you do what you're doing. The official launch date for the app and account functionally is slated for July 4th of 2026, right? The barrier to entry is intentionally low. There is absolutely zero cost associated with opening an account, and parents or guardians can make the election anytime during the year before the child turns 18. During any year, I should say. And it's got to be at least up to the year before the year the child turns 18. Get that phrase correctly. As it is. For anybody who's already assisted clients in filing Form 4547, the next phase will be the account activation you'll hear about. The Treasury is rolling this out in phases up to July 4th launch. Basically, tell your clients to monitor their email inboxes closely but warn them legitimate activation emails will only come from the specific address. No reply at trumpaccounts.treasury.gov. Setup must then be complete exclusively via the official mobile app or by manually navigating to trumpaccounts.gov on the web. Yeah, they got to deal with the electronics. Yes, a client's going to complain about that. It's like, I'm sorry, but it's free money. Figure out how to do it. Right? You need to do it. You have to do it too. Sorry about that. This is the way it works. Now, the funding mechanism for these accounts is quite broad. Activated accounts utilize a multi-source contribution model, meaning once activated, they can accept funds from family members, employers, and charitable organizations and governments subject to annual limits, and the first date they can receive such contributions will be July 4th of this year. Crucially, and this is the big thing, Treasury is funding a pilot program that will directly deposit $1,000 into eligible activated accounts on the July 4th launch date. That $1,000 is going into accounts for children that were born in 2025 and 2026. So if the account's been set up in theory on July 4th, that $1,000 should appear in the accounts for children born in 25 and 26 that have a Trump account set up for them. Now, you need to tell your clients if they do not formally open and activate the account, their child will not receive the $1,000 pilot contribution or any other external free money from employers or governments. Important to get that thing out there. Clients who have not yet enrolled can, actually still enroll. You'll need to submit IRS Form 4547 Trump account election. Submitting this form simultaneously handles the account election and enrolls the child in the pilot program. You got to fill in the right sections, but you can do both. You should be eligible. You might want to identify eligible clients with minor children and assist them in filing this form well before the child reaches age 18 to ensure they do not miss out on this unique tax advantage wealth building opportunity. Remember, in addition to the $1,000, we still have the not totally clear exactly how it's going to work and which zip codes are not going to get it. Funds from the Dell Foundation that is going to go to children who don't qualify for the $1,000 but have a Trump account. And like I said, what's not clear here, at least up through age 10 for the Dell one. But it does exclude certain high income zip codes. But I have gotten multiple statements. You'll see multiple ways that zip code exclusion is supposed to work. We need to actually wait to see what the final thing is. But the key thing to remember is even the Dell funds, those go to Treasury. Treasury then puts them in this account. That's why you got to get everything done properly through Treasury to get this done. That's going to be the key. Now, Treasury recognizes the obvious. When you're using emails and apps, the fraudsters are going to be rolling out on this thing. Be ready for that, right? This is a massive, highly publicized new government financial program. There is a very, very high risk there will be scams and fraud associated with this. Tell your clients that Treasury will never, emphasize never, big, bold, bright red letters on the page, never contact them by text message or phone calls regarding their Trump account activation. Any unsolicited call or text related to that purporting to come from Treasury is a scam. Well, what if it's right? It's like, no, per Treasury, it's a scam. Scam. Do not engage, right? Don't do that. And warn them not to simply search online for Trump account customer service, as scammers will start trying to manipulate search engines to get themselves to show up. All legitimate support is handled via secure in-app messaging, or an official online callback request. You're not going to get a phone call. You're not getting a text message. They really want you to use the app, which I know is going to stress people out, but they got to use the app. And for security purposes, you kind of need to make sure is how to do it. Make sure you're there. So here's your little thing about how you do the activation phase. And this is the sort of thing you could give to clients. Monitor for official activation emails, complete the setup via the official interfaces, and remember how Treasury is going to communicate with you. Ignore text, ignore phone calls. Ignore text, ignore phone calls. But what if it's okay? It won't be. Ignore text, ignore phone calls. Really have problems, and this especially as older clients have this problem, that they think it's impolite not to answer the phone. Gave up on that ages ago. It's not impolite not to answer a phone call from a number you've never seen or things that just don't make sense why they'd be calling you. Don't answer it. Yes, by the way, the phone number may even show up and claim to show a name of U.S. Treasury or something similar, or IRS. Yeah, don't. It's not that tough to fake that. And there are services that will fake it. So don't do that. Okay. Finally, remember the pilot program launch, the $1,000. And also, as we know, the secure support protocol. Talk about all these issues are important. Now, obviously, $1,000 doesn't apply if your client was not, did not have a child born in 25 or 26. But remind them the Dell money, if the child is not over age 10, can be in play, as well as, you just want to make sure you get things set up because presumably you set this up because you're planning to put money in there. So keep that straight. Finally, on Friday, the IRS released Revenue Procedure 2026-24 on May the 29th. And this is healthcare issues. The IRS dropped this ruling, which outlines inflation adjustments for health savings accounts, health reimbursement arrangements, and direct primary care service arrangements, right? And this will help us do 2027 projections. Now, remember, these numbers are for 27, not 26. This is always the first set of inflation-adjusted numbers we get for the following year. It comes early in the year because they have an earlier cutoff date for computing the inflation adjustment. So just remember, this is a 27, not 26 numbers we're talking about here. Okay. The Revenue Procedure has three functions here. It's required by statute. It provides required 2027 inflation adjusted amount for HSAs under IRC Section 223. It updates the maximum amount newly available for accepted benefit HRA funding, and it offers vital initial guidance on DPCSAs, which are direct primary care service arrangements, following the recent legislative enactment of them as part of the One Big Beautiful Bill Act. Now, keep in mind, again, all of these are 2027 dates, not 26. 27 amounts, not 26. So let's look at the health savings account items, right? These contributions are some nice increases for our clients. Under Section 223B2A, the annual limitation on above-the-line deductions for family with supplemental coverage jumps to $4,500, and those with family coverage would go to $9,000. Make sure your 2027 tax projection software now is taking this into account if your clients are making these contributions, right? Or they're making payroll deferrals, remind clients about how that one's going to work, that the numbers will go up next year. They can go higher. Now, also done is the high deductible health plans HDHP amounts for 2027. Remember, take advantage of these higher HSA contribution deductions. The clients must be covered by a qualifying high deductible health plan and no other plan except those that offer accepted coverage. Revenue Procedure 2026-24 provides the specified parameters required under Section 223C2A for a plan to meet the HDHP standard. For 2027, the minimum annual deductible is $750 for supplemental coverage or $3,500 for family coverage. That is the minimum deductible. Generally, they cannot pay for anything below that level except for certain specific statutory exceptions. So this is one of those things you notice when you went over to one of these plans that maybe had coverage before where you'd go to the pharmacy and you'd pay like a $5 copay or $10 copay for prescription. Yeah, the plans can't have that, right? They have to include that as part of the deductible. Okay? That's getting you up to when they start paying. Out-of-pocket expenditures must be capped at $8,700 for yourself or $17,400 for a family. Now, Out-of-pocket expenses include deductibles and co-payments, but do not include premiums. It's essential that we help clients verify their employer-sponsored or marketplace health coverage meets both of these thresholds, right? Don't just assume they have high deductible coverage. Using an HSA, make sure they have this coverage and ask if they have anything else. Are you covered under any other sort of plan? Because that's also a key question. The IRS also uses this procedure annually to update limits for accepted benefit health reimbursement arrangements. For plan years beginning in 2027, the maximum amount that may be made newly available is $2,250. And so these, of course, are, they're annually adjusted based on pension excise tax regulations in Regs 549831-1C3. That is an explanation of the calculation for accepted benefit HRAs. And then the brand new thing, right? This is direct primary care service arrangement. Now, prior to the One Big Beautiful Bill Act, having one of these DPCSAs, new acronym, carries severe risk of disqualifying an individual from making HSA contributions because the IRS viewed it as non-qualifying secondary health coverage. However, the One Big Beautiful Bill Act that was passed in July of last year added Section 223C1E, which fixes this issue for a qualifying DPCSA. Such a DPCSA is only treated as a disqualifying health plan, provided the monthly fees do not exceed certain caps. For 2027, these are $150 per individual and $300 for arrangement covering more than one individual per month. These are inflation adjusted, but for years beginning after 26. So the 150 and 300 applies for this year. Essentially, these are what you've often heard her put as concierge medicine plans, where you pay the doctor for unlimited consultations and, office visits throughout the year, but you pay them this $1 per month. My concern for a little while, I was covered under such a program. But the problem was, at that time, and this was a number of years ago, my doctor's fees at that time were more than $150 per month. So I'm a little concerned about how many DPCSA plans cover this, or in essence, really check the value they're going to offer, because I think a lot of doctors may not want to sign up and agree to offer unlimited office visits and unlimited consultations at only $150 a month. They may start asking for, and if they want more, then this will become disqualifying coverage and you can't use the HSA. Okay. So we have our limits here for the revenue procedure and the new stuff that's set up, and all the nice numbers for 27. Just remember, it is 27. The reason why that little infographic has 2027 in the upper left-hand side and 2027 on calendar in the lower right-hand side, just so that you don't forget. 2027 is our year here that we're looking at. So this is the end of this week's updates for current tax developments. We had a lot of ground, from the technicalities of the CARP tax, extensions, to the rolling out of the new Trump accounts and 2077 inflation adjustments, and some tax fraud thrown in just for fun. You want to review the cases and guidance we discussed? You can download the PDF with articles for all of the things we just discussed on the website at currentfederaltaxdevelopments.com. Again, on the same page that you can get the slides by going to the link there for weekly audio and video updates. It takes me a little while to get stuff posted there, so these things will probably go live in certain locations before they're going to go live on the website. So just be aware, if you don't see them yet, come back. They'll be there by Monday for certain. So, keep your eye on that. Otherwise, I look forward to seeing you next week as we talk about additional items that are taking place for current federal tax developments.